So the adjustment in the trading account is in a note in additional information. So that note is note 6. It says cost of goods sold includes purchases of 174,000 inclusive of VAT. So if purchases had included VAT, then the cost of sales was overstated. So that has understated the profit. So you will add back VAT included in purchases. So VAT included in purchases. And VAT included in purchases will take this 174. We multiply by 16 over 116. So that is our first add back. So VAT included in purchases 24,000. So we add back 24,000. That's in the trading account. There is no other adjustment in the trading account. So we will go down to expenses. Our expense items. The first expenditure is called directors' emoluments and staff costs, and there's a note. Look at note number 4. It says the directors' emoluments include management fees of 4840 paid to export line. So export line and Maendeleo are not independent. Actually, export line owns 75% of Maendeleo. So any cost relating to management fees is not independent as such. So we add back that management expenses or management fees of 4840 to export line because it's not at arm's length. So we say management fees. So management fees relates to export line. So we'll simply add back 4840. So we add back that and the director's emoluments. So we add back that. Then the next item there is pension contribution for staff, which is allowable. Contribution by the employer on behalf of employees. Staff recruitment cost is also allowable expense under section 15 of the Income Tax Act. Purchase of furniture 420 is capital cost. So we add back purchase of furniture. This is capital expenditure, so we add back the 420. Penalties on overdue VAT 164. So we add back penalties. On overdue VAT. We add back 164. Impairment loss of factory extension is 150. So impairment loss of factory extension is 150. These are losses of capital nature. They are not allowable. Mortgage interest. Let's see whether there is a note on mortgage interest. Did they say anything on mortgage interest? They did not. So there is no notice on mortgage interest, so we leave it. We treat it as allowable. Goodwill written off. Goodwill written off is 162. We add back. Goodwill is a capital item. So goodwill written off. We'll add back 162. Goodwill written off. Loan interest is a note 3. Loan interest related to a loan advanced by Export Limited. Again, it's not an independent cost. So we add back loan interest. It relates to export line. So loan interest is not independent. Expense is not at arm's length, so we add back loan interest of 1286. 1286 is added back. So that's loan interest. We add back depreciation of 1480. So add back depreciation. Depreciation is 1480. That is added back. General office expenses again does not have any additional information, so we allow that. So those we have in the list are our add backs. Then we'll say deduct. So we'll make our deduction. So we look at the income items. After gross profit, your foreign exchange gain. So that is business profit, unless the examiner says it is unrealized, which it didn't in this case. So that's business income. Goods transferred to a branch, I think there's a note on goods transferred, note 2. The branch sold only 80% of the goods transferred from the head office, and 10% of these goods were sold to a customer who was declared bankrupt. There are two things there. The first thing is that there are 20% of the goods that have not been sold. So there is unrealized profit. So goods transferred, we'll say unrealized profit. So this is on goods transferred to branch. So unrealized profit on goods transferred, only 80% of the goods have been sold. So 20% of these goods have not been sold. So the goods, 3,000, 20% has not been sold. So 600 is unrealized profit. Then something else happened, the same note. And 10% of these goods were sold. The branch sold 80% of the goods, so there is 20% that had not been sold. Then 10% of the goods that were sold to a customer who was declared bankrupt. So for the customer who was declared bankrupt, we'll have bad debts written off. So out of the goods which were 3,000, 80% were sold, then 10% were not paid for out of the 80. So that's 240. The next item is insurance recovery for stolen motor vehicle. 968 is a capital item. So insurance recovery. So insurance recovery. These are motor vehicles, so that's a capital item. So insurance recovery for stolen motor vehicle 968 with that. Then you have proceeds from sale of a factory extension. So again, that's a capital cost. Profits from sale of a factory is 4690. So proceeds from sale of factory is 4690. Then we also need to look for investment allowances. We need to get investment allowances. First on the income statement, do we have any asset there? Yes, we have purchase of furniture. So we get furniture here. And furniture is 420. Here 10% of 420 is 42. So that's purchase of furniture in the current year. Then we go to note 1. Note 1 says The cost of construction of the factory extension that was disposed of during the year was that. The factory extension was repainted at that. Now, that we cannot claim because we don't claim allowances in the year an asset is disposed, but we have other assets in note 5. There's a factory building, there's a perimeter wall around the factory, and there's a sewerage system, and they've given us information. Okay, they also staff quarters, processing machinery, delivery van, forklift, parking and loading bay and furniture. They're saying capital expenditure was incurred in 2016. That was 1 year ago, yeah? This is 2017. 1 year ago, when the company commenced operations in Kenya. Then the cost of the factory building also includes other things. It includes go down, retail shop, showroom and staff, canteen. So we need to adjust the cost of the factory for those other assets. Then something else we need to do, we need to get the residual value, whatever is left after after claiming for 50% last year. So the first thing we do is I'll put a note here for the factory, just for to be able to remember that we deduct certain things. So the factory building, we take the cost, and the cost of the factory building is 24,800. Then from 24,800, we lessen all that which is included under note number, it's not really numbered, but there's a go down, so we deduct the cost of go down. So we deduct go down. Go down is 800. Then we deduct retail shop. The retail shop is 400. Then you deduct showroom. And the showroom is 800. Then you deduct staff canteen. And the staff canteen is 1,900. How much is left? 2,900 is left. Now, 2,900, we want the residual. So we start with the factory building here. Last year, they claimed 50%. So what is left is 50% of 2,900, which is how much? 10 for 50. So the rate of building investment allowance is 50%. So 50% of 2,900 is 10 for 50. So 10 for 50 is the amount left from last year. 10 for 50. Then this year you claim 25%. 25% of the residual value. 26, 12.1. 0.5. So the alternative was, the other alternative was, I would have still said, get 2,900 was the cost, then multiply by 50%. Yeah, last year. So this is what is left. The residual is 50% of 2,900. Then I get 25%. It's still the same thing. So that's the factory building. Then perimeter wall is still connected to the factory. So you bring in perimeter wall, and we do the same thing for the perimeter wall. The cost was 68.20. Then you get 50% is what is remaining, because the allowance was 50% last year. So 50% of this is what is remaining. Then you get 25% of what is remaining, 25% of the residual. 852.5. Then sewerage system is something else. That's a machine, but it's okay. We'll just get machinery investment allowance for the sewerage. The sewerage system will still be the same case for machinery investment allowance. So the cost last year was 2,400. Whatever is left is 50% of that. Then you get 25% of that. So that's machinery investment allowance. And that gives us how much? 10. 300. So this is 300. Then you have staff quarters. Staff quarters is a commercial. That's a commercial building. The rate is 10%. So we bring in staff quarters. So the cost for staff quarters, was 7,600. You get 90%. Why 90%? Because last year they removed 10%. Then we get 10% of the residual. So 90% is the residual, we'll get 10% for the current year. So that's 684. Then you are processing machinery. Again, machinery investment allowance is 50%. So out of 3,700, the residual is 50%. After last year, then you get 25% of the residual. 462.5. Then you have delivery van. So delivery van is 1,750. Last year they removed 25%. So what is left is 75%. After 25% last year, so 75% gives us the residual, then you get 25% of the current year. Yes? 328.125. 328.125. Then you have a forklift. We'll deal with similarly. So forklift is 980. We get 75%, we get the residual, then you get 25% of that. You get how much? 183.75. Parking and loading bay. That's for a building investment allowance. So parking and loading bay, they claim 50% last year. So what is left, the residual is 50% of that, then you get 25%. 312.5. Then you get furniture. Furniture is 680. Last year they claimed 10%, so what is left is 90%. Then you get 10% of the residual. 61.2. And then there are these assets in which we are deducted here. We need also to bring them in. So bring them in. So starting with the go down. we bring in go down. So go down is 800 to get 90% and we get 10%. 72. So this one you said is 72. So go down is 72. Then you have retail shop. So retail shop is 400. You get 90% to get the residual, then 10% for the current year is 36. Then showroom, still the same 800, 90%, then 10%, and you get 72. Then you get staff canteen. Staff canteen is 129, get 90%, to get a residual, then you get 10%, and you get how much? 171. So with that we are done. We can get the total advance and the total deductions so that we get the adjusted profit. So advance must be 32. Or we can say, so maybe like myself, if I have let's say somebody putting on one page. So these are not disclosed to allow this person that one page is deductions ni ngapi? 12? 12,687. 07? 5. These are deductions. So what's our adjusted? So you're getting something like 21. Adjusted profit ni ngapi? Ngapi? Is this correct? 32,502. Then it cannot be 1401. That is 1381. Hakuna decimal. Oh, it's already 1,000. Sorry. Yeah, then that's my mistake. There's no decimal. It's already thousands. Oh, so adjusted profit basket happened. 1401 699 92 925. So do we have any other income to add? No, we don't. So we don't have rent or any other business profit. So this is the profit. That's the adjusted taxable profit. Then tax liability for the year will simply be 30%. The state corporation tax. So 14, 1401, 699, 925. You simply get 30% of that. 20, 509, 977 point. There are no withholding taxes, and then compute any other tax payable by the company. So the other tax payable by the company is because they sold a factory extension. This one we deducted here. This one, proceeds from sale of factory extension of 4690 is supposed to be subject to capital gains tax. So they're supposed to calculate capital gains tax. The rate of capital gains tax right now is 15% of the net gain. So how do you get net gain when you dispose property? So the net gain on disposal of property, you determine net gain by getting transfer value of property. So transfer value of property, let's suppose is XX, then you're supposed to lessen what we call adjusted cost. Maybe some value. The difference is what you call net gain. Then capital gains tax is charged at CGT. Is charged currently at 15% of the net gain. To get tax. So that's what we will do. So transfer value you get from the sales proceeds, and then you're allowed to deduct any incidental costs. The incidental cost of selling are any cost incurred while selling, like advertising of the building, any cost connected to that. So let's first get transfer value. So the building is sold for 4690. Do we have any cost relating to sale? Look at note 1. The cost of construction of the factory extension that was disposed of during the year was 2.8. That's not part of it. The factory extension was repainted at that. So that goes into the adjusted cost. When you paint a building, you're increasing its value. Well, revaluation fee for disposal, so even revaluation fee was 146.80. Okay, so we get sales proceeds. We are looking for transfer value. Sales proceeds. So sales proceeds of the building was 4690. 4690. From the sales proceeds, we'll lessen repainting and we'll lessen revaluation for disposal. So lessen, they are to repaint in order to sell repainting. So repainting cost is 75. So these are what we call incidental costs of disposing of the property. Then they also had to revalue, evaluation fee. The evaluation fee of property. Now the evaluation fee of property is 146.8. So the difference gives you what we call transfer value. So transfer value in that. 4468.2. Then we lessen what would be our adjusted cost, but the cost does not need to be adjusted, it's simply 2.8. So we'll deduct our adjusted cost. It does not have any incidental costs. We deduct here 2.8. The difference is what we call the net gain. 1668.2. So CGT will be at 15% of that. 250, 250. 0.25. 0.23 to 50.23. Then we need some theory on why investment allowances have not achieved the intended purposes for the government. So investment allowances hardly achieve the intended purposes. The question is, why is that? There are many reasons. So we want to look at some of those reasons, then finish off that question. Okay, just see. Reasons investment allowances may not achieve. Reasons investment allowances may not achieve. Reasons investment allowances may not achieve the intended purposes include. Reasons investment allowances may not achieve the intended purposes include. The first one, inflating of capital expenditure items. inflating of capital expenditure items, inflating of capital expenditure items by companies, inflating of capital expenditure items by companies in order to maximize, inflating of capital expenditure items by companies in order to maximize on investment allowances, inflating of capital expenditure items by companies in order to maximize on investment allowances. Another reason, the rates of investment allowances, the rates of investment allowances, the rates of investment allowances may be too low in certain cases. The rates of investment allowances may be too low in certain cases. The rates of investment allowances may be too low in certain cases. Next, the criteria for classifying items, the criteria for classifying items, the criteria for classifying items for purposes of investment allowances, the criteria for classifying items for purposes of investment allowances may not be clear to some of the investors, may not be clear to some of the investors, may not be clear to some of the investors. And lastly, the delays in obtaining refunds from the Revenue Authority, the delays in obtaining refunds from the Revenue Authority, the delays from obtaining refunds from the Revenue Authority arising from losses may discourage, arising from losses may discourage, arising from losses may discourage some of the entities, may discourage some of the entities from claiming of investment allowances, may discourage some of the entities from claiming of investment allowances. So that is limited companies. Then we can try questions in other corporates or other businesses, like check April 2022. April 2022, there's a sports club. Sometimes the examiner brings sports clubs. April 2022, question 1B. It's called Sambamba Sports Club. It's April 2022, question 1B. April 2022, question 1B is called Sambamba Sports Club. So April 2022, Question 1B reads, the following information was extracted from the accounting records of Sambamba Sports Club, a small signed members club as at 31st December. So receipts, your balance brought forward, subscriptions, new members entrance fees, dividend from Weko Cooperative Society, interest from Excel Bank Kenya Limited, dinner dance, beverage sales to members, investment income, payments of salaries and wages, new equipment, repairs and maintenance, furniture, office expenses, printing and stationery, purchase of beverages, dinner dance expenses, refund of subscriptions, legal fee on acquisition of investment, transport, fee to investment managers, balance carried forward, extracts from the statement of financial position as at 31st December 2021 were as follows: furniture and fittings, equipment, investment, subscriptions in arrears, accrued salaries, stock of beverages, subscriptions in advance, dividend and interest income was stated at the gross amount. Stock of beverages at the beginning of the year were 162,000. Subscriptions in arrears written off in the year amounted to 288,000. Required the taxable income or loss and tax payable, if any, by Sambamba Sports Club for the year ended. So we get the incomes of the sporting club, and then we can get the allowed expenses. So the first source of income you can get in the debit of the receipts and payments, and that's subscriptions. We get income from subscriptions. So subscriptions there was 2,500,000. That's subscriptions. Then we'll check whether adjustments to be made. For example, on the credit side of the receipts and payments, there is something on subscriptions. Yeah, refund of subscriptions of 45. So we are going to adjust for the fund for 45. So we adjust for the fund of 45. Then you go to note number 2. We have 2 items, 2 entries there. Subscriptions in arrears was how much? 300. So that's an accrual by the end of the year. So we've had subscriptions in arrears at the end of the year. Then by the end of the year, there are subscriptions in advance of 85. We subtract 85. Then there's another adjustment in note number 5. Subscriptions in arrears are written off. So you write off 288. That should give us income from subscriptions. So we make those adjustments on subscriptions. 2382. So 2382 is income from subscriptions. Then, still on the receipts and payments on the debit, we have new members' entrance fees. So we have entrance fees for new members, another 600. Then there's dividend from Weco Cooperative Society. I don't know whether the examiner says whether it's gross or net. It doesn't. Oh, we've been given a note. Look at note 3. The dividend and interest was stated at the gross amount. So those are gross amounts. We have dividend for Weco. Cooperative means it's a farmers cooperative. Hawajasema sacco. If they say sacco, it's something different. But this is a cooperative. The dividend is gross. Our cooperative society. So that gross dividend is 884. Then there is interest. So interest is from Excel Bank. So interest is also taxed twice. And it's also the gross amount. So interest from Excel Bank is 21. It's 2140. Then there is dinner dance, but for dinner dance, if you check on the payment side, you're going to see dinner dance expenses of 315. So income from dinner dance, you will get the 723. You subtract the dinner dance expenses of 315, and the income is how much? 408. Then there is beverage sales to members. That might need to work some things. We might need to prepare kind of a working note. This is beverage sales. Beverage sales. So the sales of beverages give us an income of 657. And then we have cost of sales. Cost of sales. So cost of sales, we have in note number 2, that is stock of beverages at the end. There must be stock of beverages at the beginning. It's in note number 4. Stock of beverages at the beginning is 162. So opening stock is 162. We add purchases for beverages. Purchases of beverages is given in the income statement, in the receipts and payment. It's 497. So we add here 497. So we add this 659. Then we have closing stock. Closing stock is given in note 2. Stock of beverages is 184. So that gives us cost of goods sold of how much? Cost of goods sold is 475. So that should give us the profit from sale of beverages. So how much is the profit? 190? 182. So we'll say sale of beverages to members. It's 182. Sale of beverages to members is 182. Then there is investment income. Investment income is 2.4, but if you check the credit side, you're going to see fee paid to investment managers. So investment income is 2,400,000 less fee paid to investment managers 1,100,000. So that leaves us 1,300,000. So that will give you total income. Then we lessen allowable expenses. We lessen allowable expenses like salaries and wages. We are getting those in the receipts and payments account, but you check whether there are any adjustments. There are reasons for salaries and wages to bring in salaries. Salaries and wages is 254. That's what I was looking for. Okay, there's a crude at the end of 68, so it will be 254 plus 68. 322 is salaries and wages. Then for new equipment, you're going to claim investment allowances shortly. Repairs and maintenance. So repairs and maintenance. Repairs and maintenance is 124. Repairs and maintenance, furniture, then you have office expenses. Office expenses is 415. Office expenses. We have printing and stationery. Printing and stationery is 168. Printing and stationery, purchase of beverages, dinner dance, refund of subscription. Legal fee on acquisition of investment is a capital cost. It is supposed to be added on the cost of investment. The one you see in note 2. Investment at cost, you're supposed to add there legal fee on acquisition of investment, and it goes to the statement of financial position because it's capital in nature. We're going to put transport. So transport cost is 248. Okay, so what remains now is to claim investment allowances. They bought new equipment of 690, equipment at cost. Equipment is 690, you get 10%, that's simply other equipment is 69. New equipment, then you have furniture and fittings at cost. Furniture and fittings is 240, is 24. I think that's it. So you get total income, less total allowable expenses. The examiner did not want tax, so it's just taxable income. That's income or expenses? Income is 78.96, and allowable expenses 13.17. So that gives us profit of how much? 65.26. So we were not asked for tax. So the next question, we'll do some insurance. We can do some life insurance. Life insurance question you can get from December 2021 pilot. December 2021 pilot. December 2021 pilot. Pilot paper, look at question 2D. Question 2D. December 2021, question 2D. December 2021, question 2D. December 2021 pilot, question 2D reads like this. Roman 1, explain the taxable incomes of a life assurance company. Taxable incomes of a life assurance company. Then 2, the following information relates to Better Life Assurance Company Limited for the year ended 31st December 2020. The fund balance was valued by an actuary at 220 million as at 31st December 2020. 40% of this fund balance was recommended to be transferred for the benefit of the shareholders. Premiums received during the year was 120. Outstanding as of January was 60. Outstanding by the end of the year was 40. Management expenses and commissions paid during the year amounted to 40 million and 6 million respectively. The company had no other income during the year required. Taxable income of Better Life Assurance Company Limited for the year ended. So first to explain, explain the taxable incomes of life assurance company. So taxable incomes of a life assurance company. Taxable incomes of a life assurance company. Taxable incomes of a life assurance company. The first bullet, transfers from the life assurance fund. Transfers from the life assurance fund. Transfers from the life assurance fund recommended by an actuary. Transfers from the life assurance fund recommended by an actuary for the benefit of the shareholders. For the benefit of the shareholders. For the benefit of the shareholders. Next, 30% excess management expenses and commissions. 30% excess management expenses and commissions. 30% excess management expenses and commissions above that permitted by under the Insurance Act. Above that permitted under the Insurance Act. Next point, any other transfers from the life assurance fund, any other transfers from the life assurance fund, any other transfers from the life assurance fund for the benefit of the shareholders. For the benefit of the shareholders. For the benefit of the shareholders. So for the second part, the first thing you look for, you adjust premiums so that you can get the amount of premiums received or receivable, because that would be the basis for management expenses. Outstanding premiums brought down on 1st of January. Outstanding premium. At the end of the year. So premium received or receivable is 100. Then use that to calculate management expenses. Management expenses and commissions. So what is permitted under the Insurance Act? So for you to do that, you have to remember the scale. It will not be given in the exam, yeah? Like the first 5 million management expenses should be 25%. So the scale says on the first 5M, 25% should be management expenses, which gives you 1.25 million. And you see the next. So the next goes up by 2.5, 7.5 million. This one reduces by 2.5 to 22.5%, and that gives you 1.6875. Then the next is constant, 7.5 million. This one reduces by 2.5 to 20%, and that's 1.5 million. Then the next, 10 million. This one reduces again by 2.5, always to 17.5%. That would be 1.75. Then you get excess. Excess is going to be 100 million. If you add this, you get 30 million. It always adds up to 30 million minus 30. Again, you reduce this by 2.5. So 15% of 70 should be 10.5. Then you add. If you add this, you get something like 16.6875. So 16.6875 is what is permitted as management expenses. You will compare with what the company charged in their income statement. So once you've done that preliminary step, the next is just to put your statement. The statement of taxable profit. So usually transfers from the life assurance fund are given. You'll be given that information. So if you check the question, you're going to find that information there. Like here, you're told the fund balance was valued by an actuary at 220 million as at 31st December. 40% of this fund balance was recommended to be transferred for the benefit of the shareholders. So you say transfers from life assurance fund. Life assurance fund, it is valued at 220 million, 40% has been recommended, which is 88. Then management expenses was 40 million, commissions was 6 million. 40 plus 6 is 46. But what is permitted is only 16.6875. So you say 30% of excess, 30% of excess management expenses and commissions. So the excess is going to be 46 million minus 16.6875 multiplied by 30%. 30% of the excess. $8.79. 375. So you add to get total income of 96.79375. Then you lessen the expenses that were permitted. So less permitted management expenses and commissions. The permitted management expenses and commissions is 16.6875. We deduct that. The difference is taxable income. $80.10. Then we will pick a general insurance question. Can we get a question for general insurance that was life? So a general insurance question you can find in mwaka gani? There's a question inaitwa bima insurance. Bima insurance must be somewhere in but we can do salama. Wacha tufanye salama, wachana na bima. Salama is May 2016 question 4. May 2016 question 4B. May 2016 question 4B inaitwa Salama Insurance. May 2016. Question 4 is called Salama Insurance, but we can also discuss the A theory. A says evaluate 4 features that distinguish tax havens from other taxation regimes. What are the features that distinguish tax havens from other taxation regimes? Features ni kama gani? Feature ya kwanza that distinguish tax havens from other tax regimes, you can say nil or very low. Nil or very low rates. Nil or very low rates. Nil or very low Rates of taxation on income, nil or very low rates. Of taxation on income. Another feature, protection of personal financial information. Protection of personal financial information. Protection of personal financial information or financial secrecy or financial secrecy or financial secrecy. Another feature, lack of transparency. Lack of transparency. Lack of transparency in the operation. Lack of transparency in the operation of legislative. Lack of transparency in the operation of legislative, legal, or administrative provisions. Lack of transparency in the operation of legislative, legal, or administrative provisions. Another feature, no taxes on repatriation of profits. No taxes on repatriation of profit. No taxes on repatriation of profits. Another feature, there's no discrimination. There's no discrimination between resident. There's no discrimination between resident and non-resident investors. There's no discrimination between resident and non-resident investors. Then we look at B, says Salama Insurance Company Limited provided the following financial records for the year ended 31st December. Now, gross premium, reserves for unexpired risk in January, reinsurance premium paid, claims paid, claims due on 1st January and December, life assurance fund, commission on reinsurance ceded, commission on reinsurance accepted, foreign exchange loss, rent income, purchase of computers, cost of computer software, claims recovered on reinsurance, agency expenses, investment income, management salaries, repair of rented property, neon signs, depreciation, legal expenses relating to claims, rent, and rates. Additional information, the company operates both general insurance business and life insurance business in the same building, where rent and rates are shared in the ratio of 2:3 respectively. Agency expenses include general manager's salary of $280, working in the life assurance business. Investment income includes dividends, net of tax from a subsidiary company, and $78,400 from proceeds on sale of a car involved in an accident. Gross premium includes sale of insurance policies to life insurance company amounting to $748,400. The company constructed a commercial building with shops, offices, and showroom at a cost of $6,400,000. While general rent income from the property amounted to $55,36,400 before deducting capital allowances and expenses amounting to $84,600. Required a statement of taxable profit or loss for the year and then tax payable. So the main income is gross premium, which will need to be adjusted. Let's say gross premium. The gross premium is 14,890. We'll adjust for, we'll lessen note number 4. Gross premium include sale of insurance policies to life. Life must be kept separate. 748,400. So we lessen. Life insurance. Life insurance policies may 748.4, we lessen that. We will also lessen reinsurance premium paid of 384, the paid reinsurance premium. We also lessen reinsurance. The insurance premium paid is 384. Sometimes you're given returned premium, but this one did not have returned premium. These are the only adjustments for gross premium. So how much is left?
13,757.
13,756. So that's premiums. Then we have reserve for an expired risk in January for 86. So when you have that, you look for reserve at the end of the year so that you can make adjustment. The reserve at the beginning of the year is income. The reserve at the end of the year is an expense. Now, this question did not have reserve at the end of the year. It is not there. So this one we transfer to income. So reserve for an expired risk for 86. Reserve for unexpired risk. Reserve for unexpired risk at the beginning of the year. Then you look for other incomes like commission on reinsurance given out will be 760.2. So commission on reinsurance ceded. Commission on reinsurance ceded is 760.2. Commission on reinsurance ceded, foreign exchange loss. Now, rent income 678. It goes with repair of rented property, yeah. So rent income. So rent income you pick 678.3.
Yes.
678.3. You lessen repair of rented property of 28.8. So the difference is how much?
649.5.
649.5. So that's rent income, purchase of computers, cost of software, claims agency. There's investment income of 1824, but there's a breakdown in note 3. Investment income includes dividends, net of tax from a subsidiary company. Of course, that dividend withholding tax is the final tax. Dividend from a subsidiary company. Withholding tax of 5% is the final tax. And 78,400 from proceeds of sale of a car involved in an accident. So we'll deduct those two from investment income because sale of a car is a capital gain. So we'll say investment income. We'll adjust that. So investment income is 1824.3. We subtract the 114 and we subtract gain on sale of a car. Gain on sale of a car is 78.4. 16.9. So that's investment income. Management salary, repair of rented property, neon signs, depreciation, legal expenses, rent and rates. There's another note 5. The company constructed a commercial buildings with shops, offices, and showroom. The cost was 6.4. Rent income from the property was that. So we need to adjust for that note. There's commercial property also. So note 1. Rent, sorry, I'll just say commercial property. So we also have commercial property. So from the commercial property, they got rental income. I'll say gross rent, and the gross rental income they got was 5536. 5536.4. That was the gross rent. So from the gross rent, they did not subtract certain expenses like before deducting capital allowances and expenses. So the expenses, allowed expenses of 84.6. Then you have investment allowances. Okay, the investment allowances on those constructions, they have shops, offices, so we'll get building investment allowances. Building investment allowances. So the total cost of shops, offices, and showroom is 6.4. So we just get 50%. So 6.4 million, we get 50% of that, and that would be 3.2 million. The difference we tax. So difference itakuwa ngapi? $1490.4. That is what we bring to income. 1490.4 we bring to income. So we say commercial property. $1490.4. So you add that, then you lessen allowed expenses. The main expense is claims. So you first look for claims. So we start from claims. And claims paid was 9364. So 9364 was claims paid. Then we have claims due in January. Claims outstanding. Brought down. Claims outstanding in January was 670. Then we have claims outstanding. Claims outstanding at the end of the year is 800. We get a subtotal for that, 94.94. Then we look for anything that was recovered, and it is there. Claims recovered on reinsurance is 562.8. So we say claims recovered on reinsurance. So claims recovered on reinsurance is 562.8. So if we subtract that, our claims are how much? $89.31. So 89.31.2 would be our claims expense. Then we get the other expenses in like that. The other expense would be commission on reinsurance accepted is 1940. So commission on reinsurance accepted is 1940. Commission on reinsurance accepted. Foreign exchange loss is allowable, that's 342.5. Foreign exchange loss is 342. Purchase of computers and software, we are going to claim investment allowances shortly. Agency expenses as a note 2. It includes general manager salaries of 280. So agency expenses. So agency expenses will pick 1380.7. 1380.7 less 280 will give us 1100.7. These are agency expenses. Then management salaries. Management salaries is 948.2. So management salaries. $948.2. Then legal expenses relating to claims. Legal expenses relating to claims is 64.8. Then rent and rates as an adjustment. Note 1 says the company operates both general insurance business and life in the same building where rent and rates are shared in the ratio of 2:3. So 2/5 for rent and rates. So rent and rates would be 760.4. You multiply by 2/5. 304.16. Then we get investment allowances. So investment allowances for purchase of computers. Computers need 300. We get 25% of 300 is 75. Then we have computer software. Software is 150 times 25% is 37.5%, or 37.5. Software, then you have neon signs. Neon signs is 48. So 48 you multiply by 10%, you get 4.8. So that should give us the income that is taxable. This is 18,775.6. Allowable expenses ni ngapi?
13,748.86.
13,745. 748.
748.86.
13,748.86. We subtract that. So what is our income? $50,26.74. This is taxable. So 5026.74 is our taxable profit. The examiner wants the tax, so we compute tax liability for number 2, say corporation tax liability. So corporation tax liability will be 30% of this. So get 30% of this amount. So this is 50, 26,740. Multiply by 30%, you get how much?
1508.
1508.
022.
022. Then you lessen withholding tax. So withholding tax will be an investment income of 1631,900. So investment income, which is 1631,900. You get 15% of that. 15% of 1631,900.
244.
So that's 244. 785. Subtract that. Whatever is left is corporation tax payable. $1,263.
237.
Okay, so we stop there.